Yesterday, the White House announced 25% tariffs on car imports to the U.S. These are pretty much tariffs for cars that aren't made in America. Yesterday, the stock market did very poor in anticipation of these tariffs. And today, after those tariffs were announced, the stock market still did pretty bad because, first of all, tariffs are ultimately going to raise prices for the consumer. And these automakers, especially that are importing their cars to the U.S., are either going to have to eat the costs or pass on to the consumers or build manufacturing plants into the U.S. But if they build manufacturing plants in the U.S., that might take some time, a few years. What's the best way around these tariffs? Well, to buy American-made cars. Tesla, Rivian are almost 100% American. And, the other automakers, there's risk that you might have to pay tariffs. Cars could be up to $5,000 to $10,000 more expensive because of this. So this hurt the market in the short term. It could hurt the economy and markets in the short term. However, in the long run, this brings back American manufacturing. China, since early 2000s, really took a lot of manufacturing share from us. And it's important to get some of that manufacturing share of the world economy back. China doesn't consume as much as we do. We're more of a consumer economy, but they have a much bigger manufacturing base. It's important if we getting that manufacturing base to broaden out our economy so that we're not only reliant on our services. So in the long run, it's probably good policy. In the short run, it's creating a lot of uncertainty for these automakers. What are they going to do? But as I said, the best way around it is to buy American-made cars. Tesla and Rivian are probably going to be the biggest beneficiaries of this. This makes me think that the Tesla bottom was about a week and a half, 2 weeks ago. And obviously, we'll see what happens there. But this could lead to some, this tariff policy, if consumers are buying cars from other countries that are imported to the U.S., they'll have to pay more. So this could be a little bit of a headwind on the stock market in the short term. But ultimately, once these negotiations are done, and, April 2nd, Trump's going to announce his reciprocal tariffs. I still think that's like the start to middle of the negotiations. We're likely going to see a volatile first half, but I expect at the late end of the first half, maybe late April through June, I expect a V-shaped recovery to start. You're going to start to see some optimism about the deregulation and tax cut policies. I think Trump and Bessent wanted growth negative stuff to happen at the beginning of the term. And then I think the market will start pricing in some of the growth positive stuff of the deregulation and tax cuts. Obviously, we have to see. But there's a lot of the investor sentiment index, 5 weeks in a row above 50% being bearish. That's only happened 4 times since 1987. It's usually a good contrarian buy signal. And, there's a lot of investor confidence has plummeted, but that's usually a good contrarian buy signal in general. I do expect a V-shaped recovery, as I said, in the late part of the first half. Obviously, we have to see, but there's more money on the sidelines now. And I think it'll eventually buy the dip once there's more clarity. But yes, right now there's a lot of uncertainty. And some people are asking me, with the Coreweave IPO coming out tomorrow and its exposure with AI and data center, is it a good thing to buy? Well, in my opinion, if you don't already have an allocation to the IPO beforehand, no. I think right now it's an uncertain economic environment for the market. You saw the S&P 500 just recently have a 10% sell-off, and there's some fears of like the AI bubble might have popped. Microsoft scaling back a little bit of their investment spending for data centers. So I would say no. Also Coreweave is they're heavily relying on NVIDIA and Microsoft in terms of their revenue, almost 50% of their revenue. And, in my opinion, the best play, instead of CoreWeave for data center, just buy NVIDIA. NVIDIA is kind of undervalued in a way right now. It's been consolidating for a while. Its revenue growth is great. Its earnings per share is great. Its earnings growth is great. So just in my opinion, if you want data center exposure and AI exposure, buy NVIDIA. NVIDIA is the picks and shovels play for AI. Also CoreWeave, their financials don't really look too great. There might be some accounting gimmicks going on. Who knows, obviously. But I would say I would stay away from it, especially if you don't have an allocation already. You know, insiders also have been selling recently. So that's something to keep in mind. It looks more like a liquidity event. So that's my opinion. Look, I usually steer away from IPOs in general. I wait, if I like a company, I wait for the dust to settle. Usually there's a lot of hype at the beginning, then it comes down to reality, you know, a little bit later, especially during the next pullback or next correction. And then if I like a company that recently IPO'd after a pullback or correction, then I buy. But honestly, right now, I don't think Coreweave is a great investment as of now due to its reliance on NVIDIA and Microsoft, and I certainly don't think now's the time to buy. I want to if Coreweave does well, let it run, and maybe if there's a pullback or correction, I might want to study the company a little bit more, and then I'll buy. But as of now, it's too reliant on NVIDIA's GPU chips, and I'd rather buy NVIDIA directly. The next NVIDIA is NVIDIA, in my opinion.